Business Cycle Chapter 5. uh, Chapter 5. See, Introduction. During 1920s, UK saw rapid growth in gross domestic product production levels and living standards. The growth was fueled by new technologies and production processes such as assembly line. The economic growth also caused un, an unprecedented risk in stock market values. China's recent economic slowdown and financial mayhem are fostering a cycle of decline and panic across much of the world as countries of nearly every continent see escalating risk of prolonged slumps, political disruption, and financial losses. What what are these? These are example of business cycles. The first example show that the UK economy was going through the boom during 1920s, while the second example of recent slowdown in China indicates the beginning of a recessionary phase. We have seen in chapter 1 that economics is concerned with fluctuation in economic activities. The economic history of nearly all countries point towards the fact that they have gone through fluctuation in economic activities. That is, there have been periods of prosperity alternating with periods of economic downturns. This rhythmic fluctuation in aggregate economic activity that an economy experience over a period of time are called business cycles or trade cycles. A trade cycle is composed of period of good trade characterized by rising price and low unemployment percentage, altering with periods of bad trade characterized by falling prices and high unemployment percentages. In other words, business cycle refer to a alternate expansion and contraction of overall business activity as manifested in fluctuation in measures of aggregate economic activities such as gross national product, economy, employment, and income. A noteworthy characteristic of this economic fluctuation is that they are recurrent and occur periodically. That is, they occur again and again, but not always at regular intervals, nor are they of the same length. It has been observed that some business cycles have been long lasting for several years, while others have been short, ending in 2 or 3 years. Phases of business cycle. We have seen above that business cycles or the periodic booms and slumps in economic activities reflects the upward and downward movement in economic variables. A typical business cycle has four distinct phases. These are expansion, also called boom or upswing, peak or boom or prosperity, second phase, and third phase contraction, fourth phase trough or depression. The four phases of business cycle are shown in figure 1. The broken line marked a trend represent the steady growth line or the growth of economy when there are no business cycles. The figure starts with a trough when the overall economic activity, that is production and employment, are at the lowest levels. As production and employment expand, the economy revives and it moves into the expansion path. However, since expansion cannot go on indefinitely, after reaching the peak, the economy starts contracting. The contraction or downturn continues till it reaches the lowest turning point, that is trough. However, after turning at this point for some time, the economy revives again and new cycle starts. Expansion. The expansion phase is characterized by increase in national output, employment, aggregate demand, capital and consumer expenditure, sales, profits, rising stock prices, and bank credit. This state continues till there is full employment of resources and production is at its maximum possible level using the available production resources. Involuntary unemployment is almost zero, and whatever unemployment is there is either frictional, that is due to change of jobs, or suspended work due to strike, or due to imperfect mobility of factors of due to imperfect mobility of labor, or structural, that is unemployment caused due to structural changes in the economy. Prices and cost also tend to rise faster. A good amount of net investment occur, and demand for all types of goods and services rises. There is altogether increasing prosperity, and people enjoy high standard of living due to high levels of consumer spending, business confidence, production factor incomes, profits and investment. The growth rate eventually slows down and reaches its peak. The term peak refers to the top or the highest point on the business cycle of the business cycle. In the latter stages of expansion, inputs are difficult to find as they are short of their demand, and therefore input prices increases. Output prices also rapidly, leading to increased cost of living and greater strain on fixed income earners. Consumer begin to review their consumption expenditure on housing, durable goods, etc. Actual demand stagnates. This is the end of expansion, and it occurs when economic growth has reached at the point where it will stabilize for a short time and then move in the reverse direction, contraction. The economy cannot continue to grow endlessly as mentioned above. Once peak is reached, increase in demand is halted and start decreasing in certain sector. During contraction, there is fall in the level of investment and employment. Producers do not instantaneously recognize the pulse of economy and continue anticipating higher levels of demand, and therefore maintain their existing levels of investment and production. The consequences is a discrepancy or mismatch between demand and supply. Supply far exceeds demand. Initially, this happens only in few sectors and at a slow pace, but rapidly spreads to all sectors. Uh, producers producers being aware of the fact that they have indulged in excessive investment and production respond by holding back future investment plans, cancellation and stoppage of orders for equipment and all types of inputs including labor. This in turn generates a chain of reaction in the input markets, and producers of capital goods and raw materials in turn respond by cancelling and curtailing their orders. This is turning point and the beginning of recession. Decrease in input demand pulls input prices down. Income of wage and interest earners gradually decline, resulting in decreased demand for goods and services. Producers lower their prices in order to dispose of their inventories and for meeting their finance obligation. Consumers in their turn expect further decrease in price and postpone their purchases. With reduced consumer spending, aggregate demand falls, generally causing fall in prices. The discrepancy between demand and supply gets widened further. This process gathers speed and recession becomes severe. Investments start declining, production and employment decline, resulting in further decline in incomes. Demand and consumption of both capital goods and consumer goods. A business firm becomes pessimistic about the future state of the economy, and there is fall in profit expectation, which induces them to reduce investment. Bank credit shrinks as borrowings for investment declines. Investors' confidence is at its lowest. Stock prices fall and unemployment increases despite fall in wage rate. The process of recession is complete, and the severe contraction in the economic activities pushes the economy into the phase of depression. Trough and depression. Depression is the severe form of recession and is characterized by extremely sluggish economic activities. During this phase of the business cycle, growth rate becomes negative and the level of national income and expenditure declines rapidly. Demand for products and services decreases. Prices are at their lowest and decline rapidly, forcing firms to shut down several production facilities. Since companies are unable to sustain their workforce, there is mounting unemployment, which leaves the consumers with very little disposable income. A typical feature of depression is the fall in the interest rate. With lower rate of interest, people's demand for holding liquid money, that is in cash, increases. Despite lowest interest rate, the demand for credit declines because investors' confidence has fallen. Often it also happens that the availability of credit also falls due to possible banking or financial crisis. Industries, especially capital and consumer durable goods industries, suffer from excess capital. Large number of bankruptcies and liquidations significantly reduce the magnitude of trade and commerce. At the depth of depression, all economic activities touch the bottom and phase of trough is reached. It is very agonizing period causing lots of distress for all. The Depression of 1929 to 33 is still cited for the enormous misery and human suffering it caused. Recovery: the economy cannot continue to contract endlessly. It reaches the lowest level of economic activity called trough and then starts recovering. Trough generally last for some time and mark the end of pessimism and the beginning of optimism. This reverses the process. The process of reversal is initially felt in the labor market. Pervasive unemployment forces the workers to accept wages lower than the prevailing rates. The producer anticipate lower cost and better business environment. A time comes when the business confidence takes off and gets better. Consequently, they start to invest again and to build stocks. The banking system starts expanding. Credit technological advancements require fresh investment into new types of machines and capital goods. Employment increases, aggregate demand picks up, and prices gradually rise. Besides, price mechanism acts as a self-correcting process in a free enterprise economy. The spurring of investment causes recovery of the economy. This acts as a turning point from depression to expansion. As investment rises, production increases, employment improves, income improves, and consumer begin to increase their expenditure. Increased spending causes increased aggregate demand, and in order to fulfill their demand, more goods and services are produced. Employment of labor increases, unemployment falls, and expansion takes place in the economic activity. It is to be emphasized that no economy follows a perfectly timed cycle and that the business cycles are anything but regular. The vary they vary in intensity and length. There is no set pattern which they follow. Some cycles may have longer periods of boom, other may have longer periods of depression. It is very difficult to predict the turning points of business cycle. Economists use changes in variety of activities to measure the business cycle and to predict where the economy is heading towards. These are called indicators. The type of indicators are shown in the chart. Economic indicators are mainly of three types: leading indicators, lagging indicators, and coincident or concurrent indicators. Examples of leading indicators are change in stock prices, new order for capital and consumer goods. Lagging indicators are unemployment, corporate profit, labor cost per unit of output. Coincident or concurrent indicators are GDP, inflation, industrial production. A leading indicator is a measurable economic factor that changes before the economy starts to follow a particular pattern or trend. In other words, those variables that changes before the real output changes are called leading indicators. Leading indicators often change prior to large economic adjustment. For example, change in stock prices, profit margins, and profits indices such as housing, interest rates, and prices are generally seen as precursors of upturns or downturns. Similarly, value of new order for consumer goods, new order for plant and equipment, building permits and for private houses, fraction of companies reporting slower deliveries, index of consumer confidence, and money growth rate are also used for tracking and forecasting changes in business cycle. Leading indicators, though widely used to predict change in economy, are not always accurate. Even experts disagree on the timing of these so-called leading indicators. It may be weeks or months after a stock market crash before the economy begins to show signs of receding. Nevertheless, it may never happen. Lagging indicators reflect the economy's historical performance, and changes in these indicators are observable only after an economic trend or pattern has already occurred. In other words, variable that changes after the real output changes are called lagging indicators. If leading indicators signal the onset of business cycles, lagging indicators confirms these trends. Lagging indicators consist of measures that change after an economy has entered a period of fluctuation. Some examples of lagging indicators are unemployment, corporate profits, labor cost per unit of output, interest rates, the consumer price index, and commercial lending activity. A third type of indicator is coincident indicator. Coincident economic indicator, also called concurrent indicators, coincide or incur or occur simultaneously with the business cycle movement uh, since they coincide fairly closely with change in cycle of economic activity. They describe the current state of business cycle. In other words, these indicators give information about the rate of change of the expansion or contraction of an economy, more or less at the same point of time it happens. A few examples of coincident indicators are gross domestic product, industrial production, inflation, personal income, retail sales, and financial market trends such as stock market prices.